Maybe we can probably get in Sunil Subramaniam, who's the MD and CEO at Sundaram Mutual Fund. He's going to join in just a bit. But we're going to be discussing the broader markets, the pressure that we're seeing in the small caps, as well as the overall sentiment that we're seeing for the markets. But overall, yep, I think we have him with us now. Sunil, hi, welcome to the show. Well, it's turning out to be a day of cautious trade. There were some, cautious comments which have come in from SEBI with regards to maybe froth in certain segments of the markets. We have the BSE small cap index, which is underperforming at this point in time. What would you recommend at this point?
Yeah, I think for some time now we've been recommending a more broad-based approach. To the smaller cap end of the market, it's better to do systematically, either through SIPs or STPs, or stagger your flows in. But I think large caps are a pretty safe place to play in. I do expect FII flows to sustain and hence support for the larger cap positions. I would tilt the portfolio to say 70% large caps and 30% spread in mid and small cap. And whatever mid and small cap exposure, do it in a staggered manner, not to put lump sums in.
All right. How do you suggest one does that? I mean, for the lack of fresh capital, say for instance, if as of now the ratio was 50-50, are you looking to book profits in the mid cap ends and, perhaps deploy them towards the large cap? What places are you looking to book profits in the mid cap end and what places are you looking to enter in the large cap?
So when I say allocation, I'm talking about fresh allocations. I don't think there's really need to disturb your existing purchases, because I think essentially if you look at it, the PSU segment is where there's been a lot of fraud, because I think historically discounted to the private sector, right? Huge discounts have now narrowed tremendously. So this, I'm not very sure, is on the ground of any big significant change in the PSUs operating, except for PSU banks, which definitely have a good, couple of years ahead of them. I see that. But in the rest of the PSUs, I would say it's not entirely justified by profit growth or EPS growth or anything. I think it's more the liquidity driving a catch-up rally. So profit booking in the PSUs as a broad, I think would be good, because I think they made a lot of money there. Your exposure to the industrials and the domestic economy stuff, I would suggest retain. Whereas again, in external oriented sectors, in the small and mid cap space, ITs, I would say you can book some profits there. So domestic concentration, I think, can remain. I don't need to. And when I talked about 70-30, I was looking more at fresh allocation. You don't need to go and change your existing book by selling that much of mid and small caps. Please don't read me wrong.
Okay, all right. But you're not worried about any kind of incremental downside in the small caps, even for current portfolios? Would you recommend booking some profits in terms of the current portfolios which are focused towards small caps?
I wouldn't want any knee-jerk profit booking to happen. I think if you're stuck to a mutual fund, route to acquiring small caps, that is either through small cap mutual funds or multi-cap mutual funds, there's no need to worry, because fund managers have the advantage that of the 19,000 crore SIP book, almost 30% is in mid and small caps, another 30% is in multi-caps. So half of this money, about 8,000 to 9,000 crores, is coming in the hands of fund managers to buy stocks. So if you have already invested in a mutual fund, they are going to be averaging good quality small caps when they correct. And it will definitely, from a rupee cost averaging, it will benefit the investor who stays invested in mid and small cap through mutual funds. Individual stocks, of course, that's a different entire picture. Different is there. And I would say if somebody's taken individual stocks and you've already tripled your money, you book profits there on an individual stock, but not through mutual funds.
All right. And, everyone speaks about SIP. Do you think it's time, at least for the near term, to speak about SWP, which is systematic withdrawal of the profits that one would have made, especially in the mid-cap and multi-cap space, given the sort of, money that flows in there? Nearly half your monthly SIPs go there, like you said.
Not really. It's only for a person who wants to retire or something that an SWP is a good vehicle of getting out monthly cash flows. For a person who's in his middle age, who's investing for the long term, pulling out your money from the capital markets unless you need the money. And if you need the money, you book your profit as a lump sum profit and go buy that car or buy that house if you want to. But systematic withdrawal is essentially a methodology of giving you cash flows when your regular income stops, like most salaried earners when they retire, right? So I think the purpose of that vehicle is that it's not to time the market while taking out profit. So SWP is not intended as a vehicle that way, I would suggest. It's only for retirees and those who are want to get out of the capital markets in some way.
Okay. Well, just, focusing a little more on the mid caps as well as the small caps right now. The reason I ask is that there's so much retail interest within that space. What can be done? Because, even AMFI has recommended moderating flows, rebalancing portfolios. There's some cautious comments coming in from SEBI as well. What would your thoughts and your approach be towards that space now?
So I would say that three things here. So first is the caution from SEBI through AMFI was to mutual funds to make sure that they have adequate liquidity to meet if in case there are redemptions, because they're seeing a lot of money has flown into small cap and mid cap in mutual funds and outside. So if there is some kind of a panic reaction, they want to make sure that mutual funds don't face a liquidity crunch. So the advice was to fund managers. And I think that's already happening, is that most of the small cap and mid cap mutual funds have already built up an adequate cushion of cash plus large cap stocks and larger mid cap stocks. If you study the industry, I think most of the small and mid cap funds have adequate liquidity to meet investor interest, because SEBI was also worried that if a few big ticket investors exit, are the retail investors going to be left holding a toxic portfolio? I don't think there's need to worry. Fund managers have been very prudent. They have diversified their portfolios, and this SEBI action has probably triggered a little more of creating liquidity within portfolios. So as you're aware, SEBI's rule on mid-cap and small-cap funds was 65% should be in that core mid-cap or small-cap, depending on the fund. The balance 35 is available to you to deploy. I would say that in a mid-cap fund, the balance 35 would go now 25 to large cap and maybe 5-10 to small cap. In a small cap fund, the balance 25 would go to large and larger mid-caps, and they would keep their small cap in around the 65 to 70%. So fund managers are already, I think, acting in a way that they are calming the markets, number one. Number two, for a fund manager, as I already explained, SIP flows are coming in. So they're able to, even if there is corrections, they're able to buy good quality stocks at a lower price, and that's the long-term benefit of the investor. So from an investor perspective, I'll go back to the beginning of my talk today with you all. In the mid and small cap, we are sticking to an SIP route, right? These corrections in the small cap and mid cap that are happening in today's markets would actually prove to be the true wealth creators, because you're getting good quality stocks at a cheaper rate, right? And fund managers are buying those. So there's no need for an investor to panic. Keep his disciplined approach of SIP and STP, which is put the money in a liquid fund and transfer it into equities, as their methodology of acquiring small and mid cap. I think that they would be well served in the long run. There's no need to panic from an investor perspective.
Okay, all right, Sunil, we're going to let you go on that note. Thanks very much for joining in and giving us all of that perspective in terms of the broader markets as well as the markets. As of now, we have the Bank Nifty, which is down around 1%.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.